Accounting accidentally physical inventory count. This is Ken Boy with the Accounting Accidentally website, pictured here where you can find over 400 blog posts and over 400 links to my YouTube channel, which includes videos on accounting. So this is a common question. It gets asked in the CPA exam and if you take auditing in undergrad, a question along these lines. So your firm has been retained to perform an inventory count for Premier Sporting Goods, a firm that operates 50 retail sporting goods stores. So when inventory is purchased, Premier stores the items in one of three warehouses: East Coast, West Coast, Midwest, and the warehouses supply the stores. Read each question below and match the question with the correct answer, and you can use the answers more than once. So what I'm doing here is I'm asking a question, and then the answer explains what the question's impact is on the physical inventory count. Number one, on the day of the inventory count, one warehouse ships $4,000 of baseball gloves to retail stores. The idea is that no inventory can move in or out of a warehouse on the day of the count. So the problem is that the inventory listing from the accounting system will be higher than what you physically count in that warehouse. Number two, company accountants use a December 26th inventory listing to perform a December 31st inventory count. Well, the problem here is that activity may happen between the 26th and the 31st, so the inventory listing in the accounting system may be higher or lower or even the same as the physical items you count, but the idea is to pull the inventory listing in the accounting system on the day of the count. Three is a tricky question. During the inventory count, you note 5 boxes of baseballs do not have an inventory tag. The question here is, what system are you using to print inventory tags? Ideally, it should be taken from the inventory listing in the accounting system. However, there may be cases where a different system generates the tags and the system doesn't match your accounting record. So this question needs more information really to be answered, but I like to put it in because where that inventory listing is and how you generate tags helps you answer this question. So the inventory listing could be higher, lower, or the same. 4, Premier's inventory includes $3,000 in baseball caps that are 10 years old. Sounds like obsolete inventory to me. So we need to reclassify the $3,000 from an asset account to an expense account. Premier needs to post an entry to reduce inventory to recognize the expense for obsolete inventory, which is no longer an asset. 5, after inventory is counted, your CPA firm and the client agree that inventory is overstated by $20,000, but the client does not post the adjusting entry. If the financial statements get issued, Premier's inventory balance is overstated in the balance sheet. So it's important to post those adjusting entries. 6 is different because I'm assuming in 6 that inventory gets sent out before the inventory count, but doesn't get accounted for correctly. After the inventory count is completed, your CPA firm determines that $5,000 in inventory was not counted. The inventory was on a truck after shipment from the warehouse, and the accounting records didn't get adjusted. So again, the answer to this question has to do with, did the accounting system get changed? Did the warehouse records get changed? So while I have an answer listed here, it could be a variety of answers. But I put this in here because it's a common problem in an inventory count. 7 and 8, in fact, both deal with how often you count inventory. Number 7, 5 Premier stores do not use a point of sale or POS system to post sales and changes in inventory. So the POS system is a scanner that you see at a retail location or even at a warehouse where when goods are purchased, we scan them, inventory gets increased. When goods are sold, we scan them, sales go up, inventory goes down. So the problem in the answer F, inventory is not being adjusted for purchases and sales as transactions occur. Number 8, Dayton, Ohio store uses a periodic inventory system and counts inventory once a month rather than a perpetual system that counts and updates all the time. So again, Inventory is not being adjusted for purchases and sales as they occur. And the problem with both 7 and 8 is that the accounting is delayed, and if it's not an automated system, it may cause errors. Remember that you can join Conference Room. There's the web address at the top where I have videos, live chats, blogs, and it's a community for accounting professionals. Thanks for watching. We'll see you next time.